At NEFG, we apply the GARP-style investment approach together with a strong value bias. GARP is the acronym for Growth at Reasonable Price Investing, and NEFG is a value focus when looking for new opportunities to invest. Essentially, we combine value and growth investment styles in order to create a superior way to invest.
As GARP-style investors, we seek to find companies that have strong earnings growth credentials at a reasonable price. Although it is often said that growth investing and value investing are diametrically opposed, we believe the best way to view these two strategies is in terms of the quote by Warren Buffett: growth and value investing are joined at the hip.
We apply a long-term approach when we invest capital for our clients. As a result, we are able to look beyond the immediate impact of current news flows and focus our research on assets that have been neglected by or are currently out of favor with the market.
As investors, we are value-driven when it comes to buying assets. We spend a large part of our investment process focused on the key elements of downside risk issues. We add most of our value to our portfolios from our expertise in bottom-up stock picking. We look to buy reasonable priced assets that are of a good quality.
Importantly, we distinguish between price and value. Value is what we calculate an asset to be worth. Price is what the market is prepared to pay for it. Sometimes they are the same, often they are not. When price is substantially below value, we become interested.
When a reasonable or low price is associated with a good quality asset, we are even more interested. By quality, we mean the ability of a company to withstand competitive pressure as well as the ability to increase intrinsic value over time.
These attributes of a good investment, quality and reasonable price, help us to reduce the chances of our clients suffering a permanent loss of capital. A low-priced asset has a large margin of safety to cater for the possibility of our analysts being wrong, and a good quality business can grow its way out of trouble over time.
During the transition phase, our GARP approach comes into play. This is essentially when reasonable priced assets have retracted back past the intrinsic value of the asset. This is typically the time when value investors would sell out. However, we will hold on to these assets. As long as the market price for forward earnings of a company remains near the long-term growth rate of the company, we will remain invested. The moment when this decouples, we will sell out.
Our investment approach is to consistently outperform our investment benchmarks, but during a time of extreme market top and bottom, we will underperform. However, when the markets turn for the better, we will excel faster than the market average. Likewise, we will protect capital better after extreme market tops during periods when market aggressively sell off.